Given that we really don't know where Beijing will strike next, Winston, how do you hedge?
Well, I think at this moment, for the investors, the key is to avoid the sectors that the government may consider benefiting a small group, but at the cost of the broad society. In economic terms, that means a negative externality, negative side effects, right? So these sectors will be vulnerable to tighter regulations. Which means, for example, like let's say healthcare is another strategic and important sector, or gaming, right? Tencent has started using facial recognition to make sure that the teenagers will not play the games into the night, which probably indicates some regulations coming. And then more broadly, for the large platforms that serve as infrastructure for the broader economy, let's say, the delivery service of Meituan, that kind of thing, all these will be viewed as important resources of the economy, and the government will regulate them for the benefit of the common prosperity.
So, what does this say about where Beijing sees foreign money going? I mean, are they being antagonistic towards foreign money, or is it just that they want it in their own way, within their own structure and developing capital markets?
Well, I think the crackdown is against all capital influence, both domestic and foreign capital, because the key term from the government is, quote unquote, prevent the disorderly expansion of capital, right? It's across the board. However, to your point, the existence of foreign investor and foreign capital will accelerate some of those rule makings. For example, relating to the tech sector, right? Don't forget, this is the area that has limitations on foreign ownership. And that's why, in the very beginning, why companies like Alibaba or JD.com or today, Didi would use vague structures in Cayman Islands to arrange IPO listing. So those kind of foreign involvement will accelerate the rulemaking. And on top of that, in connection with digital economy sectors, you have this new layer of data sovereignty, data security issues, right?
Winston, my question is, how do you adequately discount when you don't know the extent of the impact of the crackdown, right? How do you model valuation when it comes to a sector like education tech, which may be priced out of existence?
Good question. And to me, a good start is to start discounting. For the foreign investors, for the long time, they're familiar with discounting the SOEs, the state-owned enterprises listed overseas, like the telecom companies, et cetera, right? Because of the state governance issues. But they rarely do so for the private tech sector companies. For example, when Enter Financial was suspended for IPO, right? I also talked at the Bloomberg IPO. I said this is a tipping point for Chinese regulation to come in the sector. But for many people, they think it's specific about Alibaba and Ant, right? Another example was the crypto crackdown, starting in May, when China government announced a serious attack on crypto mining. Many people say, they will not really enforce it. But of course, it's enforcing, right? Even for the private education sector that we're talking right now. A few months ago, people heard about this. But now, as the rule really come, then people start discounting. So I think to your question, I think people need to start to discount Chinese stocks for these regulatory risks.
Right.
And they have to have plan for reasonable valuation and potential exit.